Hey guys, good afternoon. It's Denise Donahue, your mortgage banker. I have just completed shopping interest rates for you guys. So I always like to prepare a certified mortgage plan so we can analyze the numbers, make sure that the interest rate matches your short or long-term financial goals. And our philosophy is to be as transparent as possible with the numbers and really help guide you in a decision that makes the most financial sense for you and the family. So one of the things I always like to do before we jump in, I know this looks like a lot of numbers and a lot of charts, is I like to go online. People don't realize that the rate adjustments from Fannie and Freddie are public information. And so I just want to show you this because this is actually something that I think is powerful as consumers for you guys to know. But if you just pull up the regular internet browser and you type in Fannie Mae LLPA, which stands for Loan Level Pricing Adjustment, you'll see that they publish what their scorecard is for each different component. And so what that looks like is a lot of things, but I just want to show you one out of all of them. I want to show you the credit score difference versus the amount that you finance, or said in another way, the down payment amount. And so if you are, excuse me, let me move that. If you are, for example, have a credit score over 740, and you're financing 95%, which means you put 5% down, you're going to get a small adjustment, 0.25, to the rate just from Fannie Mae itself. If your credit score goes down to, let's say, between 720 to 739, that adjustment goes to 0.5. And then you'll notice it gets higher and higher as the credit score gets lower and lower. But my point is that even with the best credit possible, there's still a small adjustment to the interest rate. And this is all public. Again, prior to 2012, lenders could charge essentially whatever they wanted for the rates. But now there is a sort of recipe into how the rate market works. The difference is what the mortgage banks add as their servicing fee. So for example, if we lock in with Chase Bank, if the best interest rate that Fannie Mae is going to give you is 4.25 and Chase Bank charges 4.375, then we know that Chase is making that small 0.1 difference, and that's where they make their money. So I just kind of wanted to give you that background. I've got a whole video explaining this, but that's kind of the short version of it. I just like people to see that a lot of this stuff is public information. At any rate, so we've got 4 best rates that I want to show you, and I'm going to start with the highest and go down to the lowest. You'll see the 4.5% option is going to give you a monthly payment of $1,650. This is estimating your homeowner's insurance to be $150 a month. Now, when you get your insurance quote, if that is actually cheaper, then your payment will go down a little bit. But we have to use some sort of estimate at this point. And then we're also estimating the property taxes. So in the attached email, you have a Word document and there's a link in there. It'll allow you to click into this presentation. So if you click on more information here, then you'll be able to see the breakdown of the payment. And you'll see we're estimating $383 for taxes and $150 for insurance. So it kind of gives you that breakdown for you. And then your total funds to closing is going to be $16,730. Now, if we go down to the 4.375, this is going to lower your payment $14 a month. But it's going to cause you to bring more money to closing, about $2,000 worth for that 4.375. And so most times people are like, well, Denise, of course we want the lowest interest rate possible. But each interest rate has a different DNA makeup of closing costs and fees. And so it's important to analyze, does $14 a month savings equal a $2,000 increase in liquid cash you have to bring to the closing table? If we just use simple math, if you take $2,000 and you divide it by 14, that's going to give you 142 months, which is well over 10 years, that you would have to save $14 a month to break even on that $2,000 that you bring. So even though it sounds attractive to have the lower rate, it doesn't always mean it makes the most financial sense, which is why we prepare this plan for you. The 4.25 is going to lower your payment another $14, or a total of $28 using the 4.5 as the benchmark, and your funds to close only goes up to $19,183. So it only went up $1,000 from this option here. And then the 4.125 is going to give you a payment of $1,607, and total funds to closing of $20,434. And so to determine which option makes the most sense really depends on how long you're going to be in the house. What we do is we look at a 7-year time period or 84 months. And the reason why is because statistics show that on average people either sell or they refinance this mortgage within the first 7 years. So if we look at a 30-year time period, that's going to exaggerate these numbers, and it's just it's gonna make it look like more savings. But if you're not in the house for that long, then it's just exaggerated numbers, and we don't want to do that. So you'll see that if you brought $2,000 to closing for the option 4.375, you would save yourself a total of $164 at the end of 7 years. The 4.25 would save you $857, again, by the end of your 7th year. And then the 4.125 would save you $1,255. And this formula is derived, again, if you click on this more info here, it's also in the attached email for you in the Word document, so you can freeze these charts. I know in the screen it's a little bit tough to read. But this formula is calculated by the total amount of principal and interest payments you paid into each option at the end of 7 years. Then it separates just the principal and then the interest and mortgage insurance with each option. But it also factors in the closing cost and the points. And so in orange, you're going to get the total cost of each loan. And then in green, you're going to get the total savings when you subtract the cost. And that green bar is what illustrates these charts here for you. So it really looks at a total cost analysis for you guys. The below chart also analyzes the total interest that you'll pay at the end of 15 years. Just gives you a little bit longer time period. But take a look at this information. If you know that you're going to be in the house for 7 years or less, you are better off with the 4.5% interest rate. If you think that this might be a longer term home or a forever home, then you would consider either possibly the 4.3 or 4.2. It just really depends on how long you think you're going to be in the house. So I hope this was helpful. If you have any questions at all, you are more than welcome to call Eric or myself. We work in the same office together, so we just want to make sure we help answer any questions. And again, I just want to say thank you. I know that you have a lot of options when it comes to your mortgage, and so thank you for trusting in me and the team, and I look forward to getting you to the finish line. Again, if you have any questions, let me know. Otherwise, have a great weekend. Take care.